Hello and welcome to this Diwali 2023 special show with India's best known market masters. I'm Siddharth Zarabi and with me is my colleague Sakshi Batra. As we head into the new Samvat 2080, the big questions that investors are seeking answers to: how will the markets perform in the new year, and how can one discover new investment ideas and strategies? And joining us to help you, the viewer, seek alpha are three of India's top market masters: Devina Mehra, founder and CMD of First Global; Mahesh Patil, CIO, Aditya Birla Sun Life AMC; and Mihir Vora, CIO, Trust Mutual Fund. Welcome to the show. Let me begin with you, Devina, and do a bit of a look back, with the question being, what has the outgoing Samvat taught Indian investors?
Good evening. So the first thing is that anyone looking to invest in the stock market should not have a one-year view, whether backwards or forward. So it is not just what happened in the last Samvat, but what's happened over a period of time. And that part is really interesting because, all of us think that equity markets compound 15, 16% because that's been the long-term compounding since Sensex started. But what most people don't realize is that in theory, we know equity, the volatile asset class, but what many investors, and especially many investors are new in the market, don't realize that variation is not just from month to month or even year to year. It can be very dramatic, even decade to decade. So 1980, if you had invested 100 rupees, that would have become 700 rupees at the end of 10 years. In 2010, if you had invested 100 rupees, that would have become only 230 rupees at the end of 10 years, when fixed deposits would have gotten you close to 200. So that whole decade, equity markets gave very low returns, which is why that room has been created for equity markets to do reasonably well. And even after that run-up, which happened from the COVID lows, we are not even close to that trend line of that 15, 16% return. So, one takeaway I can tell you that the risk of a crash is not very high, at least where the large caps are concerned. Small caps are another story. So this year, of course, has been a small cap story. So for new investors, let me also caution you that that's a segment of the market that just in the last 15 years has twice seen once a fall of nearly 80% and once a fall of nearly 2/3. And then it has taken years to come back to those levels. And actually, it never comes back to those levels because the index itself changes. So in small caps, once a fall comes, a lot of companies just disappear. So that part I would be cautious on. On the other part, I would be on the large cap part, I would be much more positive. So that would be, my key takeaway for investors would be that always look at data and look at long-term data. So don't fall for someone saying that I have given 50% compounded return for the last 2 years in micro caps.
Yeah.
Because when something falls 2/3, it can triple and you will still be at zero. So understand that about the markets.
Wonderful. Mr. Patil, let me take the same question to you also. What has been the biggest learning for you, in the last 1 year? Also, in the new Samvat, where are you looking for the winners now?
Yeah, so I think last couple of years, right? In that period, we've seen a good amount of volatility which is there. After the COVID, there was a one-way rally, and then we've seen a period in the last 2 years, specifically from October 21 till now. Markets have actually not gone much, right? They are just about the peak what we had 2 years back. And in that interim, if you look at the earnings growth, right, has been fairly strong. In that last 2 years, the earnings CAGR will be around 15% or 30% absolute. So the markets are actually now no longer as expensive as what they were earlier, because earlier it was more driven by liquidity, right, low interest rates. And now we are in an era where interest rates are higher, liquidity is also slightly much more tighter. And there have been a lot of concerns, right? Geopolitical risk, what we have seen. And despite that, I think our markets, have been fairly resilient. It's been on the back of strong earnings growth in the economy. I think the economy is in a good momentum. In fact, at the beginning of the year, what we are looking at GDP growth, we've actually got, our numbers have got upgraded, and I think there are many sectors now which are looking good, right? Even compared to the pre-COVID level, a lot of sectors are looking good, whether it's banking and financials, the auto sector, the real estate sector, the investments, capital goods sector. So it's a much more broad-based rally what we are seeing, and that gives us more comfort that the economy is likely to be on a more sustainable upward journey, right? And even the earnings CAGR for the company should also be fairly decent, at least in the double digit going forward. So I would say that bulk of the large consolidation what the market has gone in the last 2 years, and especially I would say the large cap and the mega cap names, right? They haven't really done much. We have seen a lot of retail money coming into the market, domestic money into mutual funds, which has primarily been in the mid cap and in the small cap segment, where probably there's some euphoria there. There one probably needs to be slightly cautious, but I think India growth story looks, I mean, never looked more stronger than what it is looking right now. And given that an outlook going forward, despite the concerns about whatever US slowdown elections next year, I think it should be a year where you should see again normalcy coming back a bit, and we would expect markets to be higher than where they are.
Okay. Mahesh, you ended by saying that you would expect markets to be higher than where they are. Mihir, taking that forward, if 2079, that somewhat is about India demonstrating resilience despite all the headwinds, do you expect the same to play out at the macro level in the upcoming Samvat?
Certainly. First of all, happy Diwali to you and all your viewers. And thanks for having me here. I don't know whether we realize it, but as we speak in 2023, we are actually in the middle of a dream run. The Sensex has been around for about 40 years, since 1979, about 50 years now, for 40 years. And the longest yearly continuous streak of positive returns has been 7 years so far, which was the period from 1988 to 1994. As we speak in 2023, the Sensex is up about 6-7%. And this is the 8th year of consecutive positive returns. So, as we speak, we are actually in a dream run. And as you rightly mentioned, it's because of the resilience of the Indian economy. And we are here in positive territory in 2023, even without IT sector, which is one of the largest sectors in the index, having performed. The IT has not done much. A lot of the global commodities have not done much. In spite of that, we are in positive territory, which just shows that the Nifty or the Sensex, which represents the broad market, is quite diversified, quite resilient. And I think the delta of India versus the rest of the world has never been higher. So the Indian story, relatively speaking, is the strongest that I've seen in many years versus the rest of the world. And that bodes well for the next year.
That's wonderful to hear, Mr. Vora. Devina, let me take that point forward to you as well. How do you read the macro setup right now? Are there going to be more headwinds or tailwinds going forward into the new Samvat? We've had a flurry of headwinds this time around, but the resilience has played out. Geopolitical tensions, higher interest rates, inflation skyrocketing, crude prices, food prices all across. But, going forward from here, what are the big red flags that you're looking at?
Well, if you look at internationally, some of those things will remain, but geopolitical tension, and this is something this was an analysis I did at the time of the Russia-Ukraine war, don't necessarily result in market turmoil. I mean, the wars are a humanitarian tragedy. That's a different matter. But, if you look at a very myopic view of only the markets, I mean, this was something we did last year, that we looked at the last 40, 50 years, every single geopolitical turmoil, the two Gulf Wars, Afghanistan, US bombing, Libya, 9/11. In every single case, there's turmoil around that event, but it doesn't last. So
Okay.
other than the impact that, directly like Russia, Ukraine had an impact on certain energy commodities, certain agri commodities, that's a direct impact. Other than that, the markets forget it. While the wars don't get over, that's the other part of it, that no matter how mismatched the adversaries, US and Vietnam or US and Afghanistan, the wars don't get over, but the impact on the market dissipates very quickly. As far as the US is concerned, in fact, I just wrote an article this morning on this, that there's been a very strange thing. I mean, you would be surprised that US bond markets were down about 2.8% till October end. And in just 3 days of November, last week, Wednesday, Thursday, Friday, they made up 2.5% or 2.3% out of that. And so it was a very dramatic move. Basically, the markets taking the Fed's utterances as dovish, and also that a lot of the macro numbers in US showed some signs of a slowdown, and which the markets are taking positively. But whether that that comes to a Goldilocks conclusion, that the economy doesn't slow down too much, and then the interest rates don't go up too much. So that's a difficult balance. Let's see where that settles. But as far as India is concerned, I spoke about India's underperformance in 2010 to 20 relative to its own history, but there was also an underperformance relative to the globe. So almost every year in that decade, we were underperformers. So when that trend changed in 2020, I have been saying from the beginning of 2021 that Indian market looks like outperforming the globe, and I would still say that, even though this year has not been particularly good on a relative basis for India, but that still remains. And of course, it's great that we've had 7 or 8 years of a positive return. But I mean, going back to that, that analogy with the 88 to 94 period is not so great, because 94 to 2003 is the only 9-year period in Indian history with a zero return. So, that long stretch of positive return sometimes ends up with that, but
Devina,
that's
the
not
glass
my
should be
base.
half full.
No, I'm just saying that last time that stretch happened, it was followed by a totally, a stretch on the other side. But that's not my base case at all. I mean, I still remain positive on the Indian market, both on an absolute and on a relative to the globe basis. So even in our global funds, we are overweight India. So that call still remains. And yes, I mean, Indian markets are not particularly expensive. Neither has it given far higher than the long-term trend returns. So to that extent, I don't see any big risk areas, except, as I said, the small cap pockets and things like that.
Yeah.
Mahesh, I want to come to you. And we've been playing out some basic graphics, and it's very clear that if you take a look at the Nifty and all the sectors, barring oil and gas, not tracked so much, which is in negative territory, everything has been in positive, with PSU Banks and Realty performing very, very well. But I want to take this question on IT stocks. If you look at the most recent recommendations, Mahesh, it appears that most analysts have all of a sudden now taken a different view on IT, and the view that seems to be gaining ground is that everything is wrong with IT stocks. And if you take a look at 10 stocks, only 2 are a buy by most consensus. What is your own sense of IT? What has changed so dramatically for a reversal in the outlook for the IT pack?
Yeah, so if you look at the IT sector, the one sector which I think prices very immediately any kind of outlook change, right? It's most well-tracked sector, and any slight change, right? I mean, in earnings or whatever, it's immediately get reflected in the stock prices. But I would say that IT sector, I mean, a lot of the concerns there are known, right? The sector started underperforming much earlier because of the growth slowdown in US, which has kind of got pushed back a bit, right? You were expecting the downturn probably at the end of this calendar year, which is probably getting pushed out a bit. And I think the fact that US economy is going to slow down, I think is to a large extent factored in. I think on the other side, I think if you look at the sector, it's seen a lot of selling from FIs in the last 1 year because of, again, the global concerns. So it's kind of underowned at this point in time. So I would like to look at IT in a more contra way, right? One thing is clear that this year, okay, the growth rate is going to slow down from around 13-14% to around kind of a mid-single digit 4 to 5% growth. But what we see is that the overall move towards digital, right, journey which started post COVID, I think that journey is still likely to continue because only 40% of that journey is completed globally. If you look at that's the kind of data which we have. So you will see that spends continuing. Currently, there is a slowdown because discretionary spends have slowed down. Couple of lot of large IT companies, they're getting large cost takeout deals. So I would say that this is a period for kind of consolidation. You would see again the growth a year down the line probably improving because the whole digital journey should play out. And the margin levers are there, right? We've seen now the pressure on employee cost, which was there, is kind of easing off. So I would say the sector is factoring kind of negative. There could be 1 or 2 quarters more of pain over there, but it can be a good contra sector to look at from a slightly next 2 to 3 year perspective.
Mr. Vora, what about you? Which are the sectors that you're now bullish on? For the new year, which sectors will turn to be outperformers? Throughout this Samvat, we've actually seen sectoral rotation take place, and more or less we've seen most of the sectors really perform, barring IT and banks, which largely we have known. But which sectors will take the lead now?
So as I mentioned, the play is basically Indian economy versus the rest of the world, which means that, as you rightly mentioned, we'll be underweight on IT and global commodities and those kind of sectors. On the local economy, I think the economy cannot grow without credit growth picking up. And we have banks and NBFCs which are in very good shape. And if we do see corporate credit and other credit to continue to pick up, then I think IT and the banking and the financial companies do make a compelling case because valuations are still quite attractive in this space, especially both in the private sector banking space as well as the PSU banking space. So that's one. Second is the whole investments theme, whether we talk about local manufacturing or defense procurement or railway capex. I think a whole bunch of investments by the private sector and the government sector is happening, and it's likely to continue for the next few years. So the whole investments theme, including real estate, should continue to do well. So there we have cap goods, construction, defense, railway, and real estate, that pack. So that should continue to do well. The dark horse, and which is my earnest wish, is the consumption sector. That has been the weak point in the economy. Most of the recovery that we've seen has been in a K-shape, where the higher end consumption has been doing well, but the lower end consumption has not been doing well. So I'm really hoping that in the second half of this year, the lower end starts to perform, and then we can see good positive returns in the underperforming sectors like FMCG, two-wheelers, and those segments which depend on the lower end consumption.
Okay, Devina, given the uncertain global landscape, and you made the point about not taking a short-term view but a longer-term view, what are the India-centric themes that you expect will flourish in the next few quarters?
Okay, actually, what we do is, I am of the belief that no theme runs forever, no geography, no asset class, no sector.
Correct.
So we actually look at everything from base zero every quarter. That if today I had cash, where would I be? And that's the way we make our investments. So if I look at our current portfolio, this may not hold for a whole year or anything like that. Our most overweight sector still remains capital goods and industrials. And while most people kind of discovered it in 2023, we went overweight in it in October 2021. So it's surpassed a 2-year mark for us. So the question we actually ask every quarter is the story over? As of now, it doesn't look like the story is over. So that still remains overweight. In this calendar year, things which we have changed, we have added in auto components, in pharmaceuticals. These look reasonably good to us. While we've overall cut banks, we have moved more from private sector to PSU banks. We've added a few construction companies. The balance has been more bottom up. So if I look at the sectoral patterns, this would be, the changes that that again come out of bottom up, but that's the way these have panned out. And for now, that's what we are holding on to. Of course, as I said, there are things which are bottom up. Like in 2022, among our top performing stocks were ITC and Raymond's, neither of which was a sectoral kind of call. So that also happens.
Okay. Mr. Patil, any particular segment that you're going to be more bullish on? Of course, especially on the small and the mid caps, I'd like to understand after the outperformance that we've seen already, will it continue or is now the time to stay away from small and mid caps?
Yeah, I think on the sectors, primarily, as Mihir mentioned, I think it's going to be the more domestic facing sectors. I think most of the sectors are looking good. I mean, we are positive on the automobile sector. I think that's seeing a good recovery. You could see margin improvement over there. Banking and financials also, especially the larger banks, right, which haven't done much, should do well. I think credit growth is fairly strong over there. And even smaller sectors like real estate also is seeing a very steady kind of improvement. And a lot of the organized players are now benefiting because of the consolidation which is happening there in the industry. And I would say the defensive, I think, pharma sector, which has kind of underperformed last year, right? After the COVID rally, we saw that sector do well. Looks to be a good defensive, okay, to play at this point in time because the domestic, especially the pharma and the healthcare space, looks to be a much more steady secular growth. And so, yeah, so these are sectors, I think, where we would be positive. And talking about the small and mid cap space, yeah, this sector has seen a huge amount of rally in the last 1 year, as you can see in terms of returns over there. And slightly, I think the sector, because of the liquidity, we've seen many stocks, okay, across the spectrum doing well. I think going forward, I think over a longer term, I still believe that small cap and mid cap can continue to do well because if Indian economy does well, these are all more linked to the domestic economy. But I think they want us to be more careful over there because I think going forward, as we see some volatility in the near term, a lot of the stocks which have run up where the fundamentals are not as strong, I think you could see some correction over there. So I think at this moment, I think at this time, we would prefer slightly more larger cap bias. I think that's where I think the relative risk reward is much better. And small and mid caps, I think we have to be really stock specific and looking at individual companies rather than expecting the whole pack to do well. You could see some volatility or, when something has run off so much, you could see some downside also. I think investors should be prepared to face that in the near term.
Mehra, I want to take the point about banking stocks further with you. Now, specifically when it comes to PSU banks, what's your outlook there? And I also want you to tell our viewers about the impact of technology. There's an exponential change and we see newer banks, smaller banks being able to deploy multiple solutions much better, much faster. In fact, one of the largest banks still has some struggles with its technology pack really. How will that influence Indian banks in the longer term? And specifically, what's your view on PSU banks?
Sure. So in PSU banks, we do believe that there is some value left, but I don't see PSU banks getting the same valuation as the private sector banks because of the long-term track record and the fact that you do have much stronger processes and systems in the private sector. But a rising tide does lift all boats, and we are seeing credit pickup happening. And even the PSU banks have cleaned up the balance sheets, and the big chunky corporate loans, which were a problem in the last decade, have more or less been written off, and we're starting off with a clean slate for the private sector banks as well as for the PSU banks. So I think in the upcycle, because there is some valuation gap, PSU banks will continue to outperform for the medium term. But in the long term, I think the private sector banks will continue to add more compounding value. That's the base case. there was a second question you said.
The impact of technology specifically.
Technology, yes. So
more so for PSU banks, where one could argue that the pace of adoption of newer technologies is perhaps slower than some of the newer banks. I'm not taking names, but as consumers, we perhaps experience that on a daily basis.
Sure. So I would not kind of completely write off, the experience of the apps and online experience of the PSU banks. They're not so bad. Of course, the private sector banks are far superior. But if you just look at the medium term or short term for the next 1 or 2 years, what is also happening is that there is a scramble for liabilities, and because of the liquidity issues globally, I think we are in a tightening cycle, and RBI is likely to keep liquidity under control. And if credit growth continues the way it is, then there will be a continuing scramble for liabilities and deposits. And you do see also some of the large private sector banks actually rapidly expanding their own branch networks because they need the liability franchise apart from the asset franchise, which is lending. So I think the scramble for deposits in the medium term will continue, and that's where the PSU banks actually have a natural advantage. So while technology will help them in the long term, in the short term, the natural advantage that they have of the large existing branch network will help them. So it's kind of a plus and minus on that front.
Fair point.
Okay. Devina, I'll take another sector with you, and I want to ask you on the new age tech stocks, because I want to understand whether the good old days are back for them. Looking at the earnings that we've seen for most of them thus far, profitability on the operational level continuing for at least some of them for the second quarter running. How have you assessed them, and do you think the new age tech stocks will finally start to begin making some money for investors in the new Samvat?
Well, they have in between the hit lows, and then from there they did go up and so on. But that's still a sector, if you look at it as a whole, I mean, I'm not talking one or two companies, where the visibility still remains low, and we as a house are a conservative house. So, when we manage assets, as we say, 60% of what you pay us in our PMS is in our portfolio management services for risk management and 40% for return management, because I think the main job of an active fund manager is to manage the risk, to make sure that there are no big drawdowns, there are no big losses on the capital. And given that kind of outlook, we don't try to play that this thing is bottomed out and might see a run up. But yes, I mean, you are right that in many of these cases, certainly the profitability has come out ahead of what one expected when those IPOs came in 2021. A whole lot of them had come in 2021. But even so, just because something comes down 50%, it still may not be great value, which is the part which the investors have to assess, especially new businesses. What visibility do you have for 3 years, 4 years, 10 years out earnings? Those are calls you have to make, and there are enough pockets in the market where visibility is better and where you can make money. So we are not necessarily yet looking at them as investments, as I said, which is not to say that they won't make money in certain phases of the market. They will, but that's not our business, because investing is a loser's game. That's our mantra, which really means that in order to win, you have to make sure you don't lose. So that's the bottom line that we keep to.
Mahesh, I'm coming to you on the primary markets. The IPO momentum continued till this Diwali. What will happen now? There is, of course, a pipeline, but what's your own sense? Because many investors have booked fairly decent returns on some of the recent IPOs.
Yeah, so the IPO market again is the barometer of what's the level of underlying interest, right, in the retail as well as the money flow. So last year we saw quite a few IPOs coming in again. A few of them done pretty well. But I think going forward, again, a lot of these IPOs are there in the mid cap and in the small cap space, right? That's where bulk of them are. And looking at the fact that going forward, you could see some kind of a rough weather in the mid and small cap, I mean, possibly because of, say, any global risk off. So I think the IPO market going forward, I think you will be I mean, it won't be as easy as it was last year, okay, when there was enough money which was coming in. So it will be more discerning, I guess, right? Good quality companies will always have an appetite. There is always an appetite and money available at any point in time for a good company. So I would guess that well, you will see again there is a huge pipeline of companies, okay, which are coming in and wanting to get listed. But I think the pace, I think, could slow down a bit, and the markets hopefully will get slightly more discerning in terms of where they put the money.
Okay. Mr. Vora, let me ask you from the perspective of a first-time investor. You know, many of them have entered just for the sake of looking at, they have excess funds in the last few years. They've also had seen golden period in the markets. They've not really seen a bear market as of now. But for an absolute first-time investor, if somebody wants to start off with a portfolio construction this Diwali, what would you tell them?
Well, SIP is the best way to go. I would first of all not advise you to put all your money in one shot. That's where a systematic plan becomes relevant. And second is, if you're picking stocks yourself, then at least to make sure that you do some basic due diligence and understand what you're getting into, rather than just listening to some tips or some influencer somewhere. There is no shortcut. You have to use your own common sense and hard work to build your portfolio. And if you don't have the time for that, best to leave it to the professionals like mutual funds or AIFs.
Absolutely. And don't at least go by any person out there on social media promising and showing you how great returns he has had on his portfolio. Because if you really are good at it, people won't just freely dispense all of that advice. But Devina, I want to come to you for a brief moment to move away from sectors, and which is the fact that, to do with our politics. It's very clear that as far as the Indian market is concerned, there is some amount of short-term volatility before and after an election. And I'm asking you this question in the context of the results that we are going to see on the 3rd of December, and then in a few months, of course, the big one, the national election. The markets would like to believe that they are guided by policy and valuations, but when it comes to reality, it's sometimes different. What do you expect is going to happen as far as our markets and the overall political dynamic is concerned?
Actually, the markets themselves also won't know how to react to something, because if you look at the past, very often it has happened. And 2004 is an example when the market on result day reacts one way, and within a few weeks it goes completely the other way. So anything can happen. It also depends on where market is poised on that day, how much it has gone up or down at that point, and therefore how it reacts. And as I said, that one day reaction also is not a very good parameter of how the market will eventually take that result. So I don't think you should look at any kind of knee-jerk reaction to that. And I think at the end of it, the economy and corporate earnings have their own momentum, and eventually that is what would and should drive markets. So I am not overly concerned with this and trying to predict it, and therefore a second order, third order, how will the market react on that day? How will it react a week from there, or a month from there? So that's not the way, as an investor, that's not a very useful way to spend your time. So you talked of asset allocation. I would say that as an investor, whether new or old, get your asset allocation right. So even for a young person, I never say that put 100% of your assets in equity. So look at how between equity, fixed income, gold, real estate, how do you want to split your money? Are you there yet? Do you how far are you from where you want to be? Do you even know what your current asset allocation is? So get all of that right. That is more important rather than trying to predict election results. And for whatever you want to invest in equity, I would say now is not a bad time. You can split it over 2 months, 3 months if you have some money lying around, but now is not a bad time. And the reason for that is that in markets, all of us understand the risks of investing in the market, that if you invest, your portfolio might go down. but there's also a risk to not being invested in the market, which means that you miss out on an up move. When I was looking at the data, not even half the mutual fund investors remain invested even for 2 years. So on this nice looking chart, you see that 15, 16% equity compounding, but hardly anybody captures it because, when the market falls, you panic and you exit. And at the end of it, you don't capture that up move. So unless there is an imminent risk of a big crash, most of the time in the markets, whatever is your equity allocation, you should remain invested. And as I said, that right now I don't see the big risk of a crash because you're not far above the trend line. So as far as the large caps are concerned, this is not a bad time at all to be invested.
One quick follow-up, Devina, before Sakshi comes in. Gold, and the numbers are showing it on the screen, top performing asset class. Do you think gold will continue to be a safety bet in the days, months and years to come?
See, gold should be part of your asset allocation, but no asset class gives you this golden thing that you will have returns without risk. Just to give you some perspective on gold, if you look in the international price of gold, the dollar price of gold, from the early 80s, it was 20 years it gave no returns. So that early 80s price was not crossed for 20 years. So what happens with most investors is that it's a very knee-jerk reaction that this asset class has done well for the past 1 year. So let me jump there.
Yes.
1 year equity markets don't give returns. Why was I not in fixed deposit? I would have been better off there. Gold does well for a few months. You want to jump there. Don't do that. So have your asset allocation should broadly remain steady. In India, of course, gold did give some returns, which was because of rupee depreciation. But now you don't need to have gold to play the rupee depreciation. So when you talk of asset allocation, yes, so this was one thing actually I missed out, that you must have global exposure now that you can have global exposure. So that's in fact a cause for me to get Indians to invest more globally, because there is no reason why 100% of your assets should be in a market which is still only about 3% of market capitalization of the world. So that's why our global product start at just $10,000, which is about 8 lakh rupees. Whereas normally that kind of product you won't get below $1 million. So that's the other part. So, have some money globally. Now you don't need only to invest in gold as the only way to get a dollar hedge, which was the case earlier.
That's wonderfully said, Devina. Mr. Patil, let me come to you. We've been all discussing the long-term prospects of markets and all asset classes is going to be important. But at the same time, we have to ask you, where do you see the Nifty until next Diwali?
Well, again, I would not want to hazard a guess because whatever predictions what you make, okay, there are a lot of factors. But I think clearly, as I said, it should be higher from here because, as I said, the overall underlying growth momentum, okay, in the corporate India looks to be fairly strong. We are seeing across sectors, except barring a couple of sectors, where the outlook could be weaker. So, and I think as you move forward next year, a lot of the concerns which are there, right? Elections would have been behind us, interest rates, right, which are still currently high, and I think you would have been talking about possibly rate cuts. So given all these factors, I would guess that the market seems to be on uptrend. I don't see we're still in the kind of bull market is what I see for India, right? Indian economy is nowhere near its peak. Okay, we've just begun the journey. I think there is a long way to go over there. So for investors, I think just looking at next year returns, I think would try to really play that, I think would not make sense. I think the long-term journey is very good. For the first time, as I said, we are looking at a visibility of India continue to sustain a reasonable growth for a longer period of time. And that's where I think wealth creation will happen.
All right. One final question to you, Mihir, and this is the same point that Devina spoke about, because a lot of our viewers would be wanting to know what would be an ideal portfolio for them to have and what the composition of the assets that they put into it in the upcoming year.
Sure. So, there is no one size fits all answer to this, because the asset allocation will depend on a lot of things like your risk profile, your age, your liabilities, social commitments, etc. But if I were to just talk about each individual asset class, I would say about 2 years ago, when we were in the interest rate cutting cycle, and we had a big stimulus, and equity markets had really crashed 2 to 3 years ago. I would have said that equities is clearly the by far the choice, and you should have put all your money in equities. But now we are at interest rates which are also quite high. 10-year bond yield it's about 7.2, 7.3. To that extent, even fixed income is looking relatively more attractive than it was 2 years ago. So I would say that if you were putting 100% in equities last year or year before last, there is some scope to put some money in fixed income too. Gold, I think, also to some extent, I would not recommend a big allocation to gold, but to some extent to hedge against the overall volatility in the portfolio as a diversification also would make some sense. But of course, equities would remain the dominant proportion.
Well, that's absolutely spot on. And viewers, if you've been wondering where you should deploy your money and how you can be smart about it, here were India's best and smartest money managers who told you what is the best way to put a front foot into the new Samvat. Devina, Mahesh, Mihir, thank you very much for your time. And it's a wrap on this show. On behalf of the entire Market Today and Business Today television, we are signing off. See you soon. Happy Diwali.
Happy Diwali.